Good afternoon, everyone. I am Angela Giroux, and this is Your Money Matters. I am with Ted Bauman and Clint Lee. And I always like to remind you that if you want more research from Ted, deeper research from Ted, more specific stock recommendations, please join us at the Bauman Letter. There's a link above with all the details. It's completely risk-free. And especially after watching today's video, you might want to join because I am sorry to say we're seeing some nervousness creep back into the market. All the same reasons we've been seeing, that the supply shortages, the labor shortages, inflation, the Fed may raise interest rates. But now, obviously, it's having an effect on business because we're getting some earnings reports that are just, well, terrible. I'm going to pull up a chart here to take a look at some of the worst offenders. And you can just see here, I mean, it's nasty. Peloton down 36%. Disney really rocked the market, negative 4.7%. PayPal, 5%. Robinhood, 8%. It's important to note, PayPal actually fell after the CEO lowered expectations for the fourth quarter and the full year, but the effect is the same. Now, before you jump on us, don't do it. Listen to what I'm saying. We are not calling a top. We are not calling for a crash. All we are saying is that everyone should be prepared. It's something that Ted has done in the Bauman Letter before. You did it last year when the stock market was looking shaky, and it worked. We had positions that held their value while everything else was sort of falling apart. So that's what I want to talk about today. If, God forbid, something goes wrong, because you never know what's waiting around the corner, how do investors hedge against that, Ted?
Well, thanks. I mean, it's important to point that out because you need to distinguish between a sharp correction and the long-term trends. I mean, last year when the market sell-off occurred in March, everybody thought that's the end of the world. It's finished. We'll never see stock gains again. But look what happened. So the critical thing is that if you want to preserve a chunk of your portfolio against decline, the kind of corrections that can happen anytime, especially now that you've got so many algorithmic trading systems that can, amplify downward moves and options trades, which can do the same thing. It's a good idea to have a plan B in your hip pocket to say, well, I want to put a portion of my portfolio here so that it'll either maintain value or even go up while the market's going down. So our position is still bullish. We still see major tailwinds coming from all these big changes like EVs and renewables, these new innovative technologies. And right now, my favorite sector of all, the microchips, all the stuff that's happening there, we're going to see big gains. But you always, never go out to, in your boat without a life jacket, right? So that's what we're doing. So the problem is that the short-term situation, the risk situation is a bit elevated right now. And if you're going to be a responsible investor, you got to pay attention to that. So the first thing is I'm going to flash a chart that shows market valuations as a percentage of GDP. I know this is something that Warren Buffett likes. And look where it is. I mean, basically, we're at 170% of GDP. That means that the value of all listed companies in the United States, their outstanding shares is 1.7 times the GDP, which is just outrageous. I mean, we didn't get anywhere close to that even back at the 2000 thing. Now, the next chart is inflation. We know about this one. This is the one that everybody's going nuts about. I'm still an inflation dove in the sense that I believe that these are transitory supply side things. If the Fed raises interest rates to try to choke this back, then that's going to be very, very bad, because you can't use interest rates to address supply side problems. Nevertheless, it is what it is. I mean, and it's been growing all year, and we expected better results in October. We didn't get them. And that in turn is leading to increasingly negative consumer sentiment. Here's a chart that shows basically the University of Michigan Consumer Sentiment Index and then the month-on-month change. And, it's kind of pretty much as bad as it's been for a long time. The only time we saw worse was in August, September this year, and of course back in the COVID times, but it's a big drop. So the big thing is that if we are going to see inflation, and if politically the White House is under a lot of strain saying, you got to do something about inflation, well, the only thing that you can really do is try to slow the economy by raising interest rates. That's the only lever you actually have. The problem is that if you do that, you then start looking at problems with the stock market. So here's a chart that shows the relationship between real yields and the stock market, and it's pretty close correlation. Look back there, you can see, it's just almost a mirror inverse. Not quite, but it is. So if the real yields on the 10 start going up again, then we could see a big sharp pullback. Problem is that the average investor has moved way out on what we call the duration curve. In other words, when you buy into stocks that are expected to generate returns far in the future, then, which is something that you can do when interest rates are very low, then you're putting more of your assets into interest rate sensitive assets. And if interest rates change, they can fall. So here's a chart that shows duration risk really in the blue, dark blue, and then the US 10-year bond yields on the other side. And the problem is that, if you start seeing a rise in bond yields, then that high spike, that it's going to hit these duration stocks. That's the growth stocks, the ones like the Pelotons, for example. It got hit for a different reason, but it got hit nonetheless. And part of that has to do with inflation and interest rate concern. Last thing I want to show you is what's happening to bond yields. This is the 1 to 3 year Treasury bond ETF, and it's in inverse to the yield. So as yields rise, its value falls. And you can see there's been a steep drop off since really it started in summer and then picked up a lot of steam in October, and now it's just falling off a cliff. So but basically the big issue here is that if we do see big moves in interest rates, given the nature of the portfolios that people have, given the high level of valuations, you want to be hedged.
That's right. Yeah. And, one of the things I want to talk about too, as well, Ted, is the different types of hedges that are out there, because the term, it gets thrown around a ton, but it's a pretty wide umbrella in terms of, what all, constitutes a hedge. I think there's really three key areas to hone in on. One is just kind of simply the value preservation. Things like just, moving a portion of your portfolio to something like cash or, some other safe haven, a shorter duration type of assets, that's shifting your portfolio actively in that manner. Another way is just through diversification, portfolio diversification, holding assets that are uncorrelated or ideally inversely correlated to stocks, so that, if we do see a drawdown in the market, those things will zig when stocks zag. And then there's also different types of inverse strategies and option strategies as well. For inverse strategies, ETFs that are designed to do the exact opposite of what an index does. So if you're seeing a falling S&P 500 index, these things are designed to go up. There's even leveraged versions of those. One thing I would be careful about though is on these inverse ETFs, especially the leveraged ones, is that their tracking error, what you would expect them to do, can diverge pretty significantly especially over a long time. So it's not something you want to hold for a very long period of time. And then what I mentioned too, you got all kinds of option strategies that you can implement to hedge your portfolio there as well.
Okay, so there's just some broad ideas of hedging strategies, but Clint, can you get more specific on which ones you might recommend?
Yeah, so I think right now, we talked about is we highlighted some of the risks that are out there for the market, but overall there's still a lot of tailwinds. Wouldn't be surprised to see more upside here in the market. So one way you can take advantage of the upside without making some wholesale shift in your portfolio is with options, specifically with put options, because all you're doing is you're paying a premium to buy some downside protection. Really, I mean, that's how a put option works. It's really portfolio insurance. It'll gain in value as the underlying security that it's tied to goes down. Actually, here's a payoff diagram of how a put option works. This comes from Investopedia. Just a simple example. So you've got your profit or loss on the vertical axis and what the stock price is doing on the horizontal axis. As the price, if the price of the underlying security is going up, if it's moving to the right, you see this line, your P&L line kind of flattens out. That's because you're only out what you paid for that option. But if the stock price declines, if it moves to the left, that's when your profit starts to kick in. So once again, this is a way to put on a hedge without having to shift a bunch of your underlying long positions that you own around. If you want to see an ETF example of this, there is a Swan hedged U.S. equity ETF, ticker HEGD. And what they do is they hold a basket of passive ETFs, and they buy put option protection on that. So you're still able to participate in a lot of the upside that's in the market while hedging against really those really bad market drawdowns. Now, another strategy I would mention is, when we start talking about diversification, I think you got to be careful because, take the cornerstone sort of retirement portfolio. Everyone talks about the 60-40 portfolio, 60% allocation to stocks and a 40% allocation to bonds, and you think you're diversified there when you're doing that, but that's talking about the dollar breakdown allocation. 60% of your dollars go to stocks, 40% to bonds. But when you look through to that, you're really seeing about, in terms of where your risk is coming from, about 90% of your risk is coming from stocks and only about 10% from bonds. So here's a chart just to kind of illustrate that point on here. So you're diversifying in that type of manner is can be very misleading. And so there's a strategy out there called risk parity, and I can already feel eyeballs rolling in the back of people's heads. But risk parity is a very simple concept. It just, instead of looking at the dollar allocation, it looks at that risk allocation and tries to balance things out. So in this case, to balance out your risk, you would hold more bonds relative to stocks. An example of that type of strategy in an ETF product is with ticker RPAR. It's the RPAR risk parity strategy, and they allocate amongst stocks, commodities, tips, and treasuries, but doing so in a manner that balances that risk profile. And a good risk parity strategy will be one that's dynamic, meaning as the risk levels evolve, it's going to shift its allocation. So, when stocks are falling, the risk of stocks tends to be going up. And so a good risk parity strategy will naturally reduce your exposure to stocks through that manner. So it's a self-correcting mechanism in a way. The last thing I would highlight on here, one of my favorite hedges, just talking purely about an uncorrelated asset, is simply with gold. If you go back and look at gold, what gold has done versus the S&P 500 in the last three really significant bear markets. So here's from 1999 to 2003 during the tech bubble burst, gold being the black line, the S&P 500 the blue line. You can just see gold taking off, maintaining its value and ending the period up 45% on there. Fast forward to the financial crisis, same thing. So here's gold versus the S&P from 2007 through 2010. Once again, you can see gold rising as the S&P 500 and maintaining its value as the S&P 500 is just absolutely collapsing. And then you want to take the most recent period last year during the pandemic. So here's a chart for just 2020. You can see, on the left-hand side, you see gold maintaining its value as the S&P's selling off, ending the year, gold up 25% versus the S&P up 15%. So just another example of just how to diversify or bring in an inversely correlated asset to help hedge your portfolio from that downside.
Ted, any ideas? Any other ones?
Yep, I do. I think Clint's right about gold, but there is another way to play the gold thing, and that's what we call covered call ETNs, exchange traded notes. And these are actively managed strategies that use calls on things like gold, basically the futures, to try to generate additional income above and beyond the boost in the price of the underlying asset, gold. And they can pay some pretty serious dividends. I mean, you're talking double digit, even into the 20s during certain kind of market periods. So particularly if you're an investor who likes income, these can be good long-term bets. Obviously, they perform better when the gold price is rising. But if you buy them at the right time, they can help. Here's a chart of one called GLDI. It's but basically just that. It uses call options on gold futures, and you can see that after a slight dip in the coronavirus crisis, it rose again pretty rapidly and maintained its value up until the point where the stock market was clearly back in business. And at that point, it began to pull back because the price of gold fell because of the recovery in the stock market, but it kept paying out pretty hefty dividends. And I think that's an important consideration. Just out of curiosity, this morning I looked at this same thing over the last 5 days as the market has taken a hit, and you can see that it's an inversely correlated. But what I like about it is that whereas gold doesn't generate any return on its own, it's just a store of value. This will give you a little bit of dividends, actually quite a lot of dividends. The other thing I like is currency ETFs. Although it's, I think some of the dynamics have changed as markets have changed, but the yen and the Swiss franc are two, famous hedges. Here's a chart that shows the FXY and FXF, which are both ETFs that are reliant on the underlying price. Here's the drop that happened last year when, the coronavirus dropped. Look what happened. They both went up. Then they kind of stabilized it, but they remained at previous values, so you didn't lose any money. You could have maybe gained some if you sold at that top, but they pretty much tracked the market right up until late in the year when the market began to rise a bit. But those are another ones. And then the last one I think is basically just to try to figure out what your like as Quint said, what your diversification strategy is. And there's no specific chart for that, but the idea is, as we keep telling people, because a lot of people, with our services, sometimes we have such a convincing talk about a position, they put everything in it. Don't ever do that. Never put everything in one position. So the main thing is make sure that your stocks are diversified. I'm a big believer in making sure that the bulk of your portfolio is companies that generate a lot of cash, that pay dividends, that are going to survive no matter what happens, because whatever happens, you need them. People need their products. Don't put everything into pelotons, right? I mean, that's your mad money, and I think that's the most important thing right now. It's time to look at your portfolios. This is something I've been saying actually going back into the summer. You want quality, you want income, so that's the core.
All right. Yeah. And just a reminder, if we see those comments that are yelling at us that we're calling for a crash, I'm going to get in there and I'm going to start fighting, which is not what we're saying.
Not calling for a crash. We're just saying,
calling for a crash.
No, we're just saying, look, do you have a parachute? If you're going to go hang gliding, you better have a parachute.
Yeah. You never know what lies ahead. If anyone had told me in 2019 that we'd still be dealing with the fallout of COVID-19 and it's almost 2022, I would have never believed it. So have a plan B. And in this case, the B stands for Bauman. So make sure you check it out. We'd love to see you over there. Ted and Clint, thank you very much.
Great. See you next week.